Tradelo trading floor. It's April the 23rd and some highlights from today's show. Powell is set to see out his term, US bond issuance remains a key risk, and Bitcoin is not a safe haven. A good day, traders, and welcome. Hopefully you all had a very nice Easter break. It was an important time to take a step back, re-energize, and of course get ready for what comes next over the course of the next 3 months as we move into the summer months. Now, starting off today, our first topic is all about Powell is set to very much see out his term. It's been a bit of back and forward, and I think there's a key lesson to take away from this news, and that's why I want to stress particularly this article. So let's head over to our first topic of today, which was we've now seen Trump do a little bit of a backtrack again. And I stress the again because there's something key to take away from this. We're learning in real time what Trump's playbook is when it comes to rhetoric and, of course, decision making. Now, you all obviously know what's going on Friday or Thursday late. He came out and said, look, I'm very unhappy with you, Powell. You need to cut rates a lot quicker. And Powell came back and he sat in a press conference last week and basically said, look, we need to stay paused. We need to stay put. We don't need to be doing anything anytime soon because we need to understand the lay of the land. Trump didn't like it, pushed back, said, you need to cut, you're a terrible chairman, and I'm going to fire you. Okay, and then he went on to say, look, if I want, I can fire you, and blah. You all know what came after that. The point is, markets kind of staged a little bit of an aggressive sell-off coming into Monday. Of course, it was an Easter break across most of Europe. So most of Europe was off on the day, and liquidity was extremely light. I mean, there was very little in the way of volume trading. So it was very thin markets, but what we learned was how quickly Trump then came out and backtracked. Okay, and this is key because what we've now seen twice in a space of, call it 3 weeks, is that whenever the bond markets, and in particular the dollar, start to showcase sensitivity to some form of a Trump, rhetoric. In those instances, when we see that US curve very aggressively steepening and we see the dollar selling off very aggressively like it did on Monday, we then typically get the backtrack from Trump. Now, yes, he's told us he's not watching the stock market. Now, again, whether you think that's true or not is mostly irrelevant. What I can tell you is he's definitely watching the US bond curve. Why? And this is the key. Don't forget, Trump's objective with this entire tariff play is very simple. He wants lower interest rates. He needs lower interest rates because the US is trying to refinance itself in terms of the debt load it's got, and it's very much trying to pull back the amount of debt load it's got because of the interest expense that's coming due. And we'll talk a little bit about this in a minute because this is a massive risk for the US government. It's the risk they are trying to curtail at this point in time. They are desperately trying to get those interest rates lower so that they can refinance themselves, particularly with longer dated maturities. We'll talk a bit more about that in a minute. Now, why this matters is because whenever we see yields rise, that is going counter to what not just Trump wants, but what Benson is telling him he needs. Okay, so that is the playbook. Whenever yields rise because Trump says something, at that point in time, you can expect there's going to be some degree of flip-flop. There's going to be some degree of pullback. And I think that is now the playbook you have to go into every single one of these weeks. You know, we're going to see a lot of negotiations going on with the likes of, Japan and eventually at some point China. Watch what the bonds do. If yields rise, if 10-year yields get back above 50%, guess what? You're going to see a very quick shift from the US government. They're going to very quickly try to do whatever they can to get those yields moving lower. They do not want yields higher. That's the key takeaway from all of this, okay? Now, in terms of that, this is the chart, okay? And this is the key. This is why I'm pointing out this chart. Look how much, you go back to Liberation Day. Look how much the curve steepened, okay? That's a massive 15 basis point steepening. Fine, it moved sideways, and then all of a sudden, look how much the curve steepened again, a good 15 basis points. In both instances with that sort of steepening, what did Trump do? He backtracked, and not only did he backtrack, he did it pretty quickly. Okay, we're talking about 48 hours. He was backtracking on very aggressive rhetoric. Okay, this is the key now. When yields rise because Trump says something, be ready for the rhetoric to be calmed down and the de-escalation, and of course, the tradable opportunities that come with that. Okay, we can also see it, of course. We did initially see that 10-year yield yield sell off very aggressively. It then rallied, and that's what really turned up the dial on the US government backtracking. Okay, initially they got lower yields, but then the back end started to sell off very aggressively. What did Trump and Benson do? Oh, no, we don't want to raise tariffs anymore on China. We want to negotiate with everyone. Let's give everyone a 90-day pause. Okay, exact same thing. We saw that gap up. We saw the 10-year start to rise on the whole rhetoric around Chairman Powell. All of a sudden, we see we're back up above 445, and all of a sudden, we get the backtrack. Okay, the point is, yields are ultimately determining policy now and nothing else. Okay, so that's the key takeaway there. Now, the next thing is, in terms of topic, is this idea. There was the Goldman Sachs CEO, Blankenfein, came out yesterday, and he was on CNBC, and he said something very interesting, and I think it's important to take away what he's ultimately talking about. And he used this term, and I kind of trying to quote him, forward expectations of US growth. Okay, so all it is what the market thinks US growth will be, think 5 years from now, think 10 years from now. Now, to have a look and try and understand this concept, what we've got in the bottom here in the purple is effectively, think of it as a 10-year moving average of US growth. Okay, now the general thinking, the general consensus on Wall Street is that 2% growth is what's baked into the next 10 years. Okay, that's what Wall Street thinks the average growth rate is going to be over the next 10 years, assuming all things being equal. In other words, assuming everything continues like it's expected. Okay, now that's very healthy. 2% US growth every year for the next 10 years is a fantastic economy. Okay, however, this year suddenly we've been thrown this curveball. Suddenly now we're getting tariffs and deglobalization, higher inflation everywhere around, higher interest rates. And so all of a sudden Wall Street's been given a bit of a shock here, which is, well, hang on a sec. Maybe 2% is not the 10-year growth rate we can expect going forward. Maybe it's 1.5%. Maybe it's 1%. Maybe it's a Great Depression. We just don't know, because what we need to wait for now is an understanding as to what is the tariff policy going to be going forward. Moreover, are they going to be there long term? Moreover, what's that going to do to deglobalization and supply chains? We don't know. We are going to know in the next 6, 12, 18, 24 months, but we just don't know right now. And so what Wall Street's trying to do is it's trying to put a big question mark on what is that number. Is it 1.8? Is it 1.5? Is it perhaps still 2? Okay, if it's perhaps still 2, well then right now, the stock market, as you can see the NASDAQ in purple, the stock market ultimately has repriced already for something less than 2. Okay, so this is kind of how you have to think about growth going forward over the next, couple of months, which is as the hard data starts to come out, as we start to understand these, tariffs better and the implications of them, Wall Street's going to try and put a number on what forward growth expectations are like. Okay, and from that, the stock market will need to price itself. Okay, that's the key takeaway. In this environment right now, the market is not conducive to trying to be long for any period of time. Okay, in other words, if you are going to be buying the stock market, fine. There are tactical buys, of course they are, and we are going to be having some very aggressive bounces. But in reality, until the market can pinpoint exactly what those forward growth expectations are, there's absolutely no point in investing in the stock market. Okay, and that's the key takeaway I think Lloyd was trying to get across. Now, one period that I think is very interesting to look at is actually the period between 2004 and 2007. Why? Well, because those were the preceding years into, of course, the 2008 financial crisis. And you could see we were trending lower. Okay, the green line is just effectively the 1 year growth rate. And you can see we very much trended lower for those 3-4 years. And we were very much underperforming that long rate of growth. And you can see in that period, what did the NASDAQ do? Apologies. 27%. Okay, so it's not to say that weaker growth expectations mean a poor stock market. It just means lower than expected returns. Okay, and very, very importantly, and this is the last point I want to stress on this chart, we pretty much hovered around that line of around 2%, slightly below from 2011 to 2015. So growth was really kind of sticking around that long-term average. Of course, we saw a little bit of, sort of a slowdown into that 1.5% over those years. And yet the stock market was up 580%. Why? Well, because we had that wonderful thing called quantitative easing. Okay, so growth is not the only thing that drives the stock market. It's a thing, and it's a very important thing, but so is the central bank policy. Okay, now could this time be different? Well, right now the central bank's reluctant to provide any kind of support. So right now it's growth that is going to ultimately determine where the stock market gets to. But should we see lower interest rates and eventually QE, yeah, don't be surprised to see an economy that runs at 1%, perhaps 1.5%, but we still see a very, very strong, robust stock market. Okay, so keep that in mind. Now, a very, very interesting article. Go read it. It's all about could Trump borrow a page from Argentina's debt swap playbook. I think this is fascinating, particularly because I know Trump is one of the first people, if you go back to 2017-18, he was one of the first people to come out and talk about centenary bonds, okay, so 100-year bonds. And he was lambasting everyone and say, well, why the heck are you not ultimately taking advantage of the fact that the market's willing to borrow you money for 100 years at almost 0%? And everyone shrugged it off. They're like, oh, that's a stupid idea. In reality, it actually turned out to be a fantastic idea that was never eventualized. Now, what I want to stress from this is if you go look at Argentina, and you can read this on your own, but Argentina did something very similar called a mega debt swap. And in a very basic English sense, what it means is, hey, debt holders, your debt's about to mature. How about we just shake hands and agree that you keep the same debt at the same rate for another 5 years? Okay? And that's ultimately what happens. You basically just come to an agreement, a negotiation with your debt holders to just roll over the maturity of the debt, extend it into the future. Okay? And this is the general thinking here, is that given the amount of debt load that the US has to refinance this year, and given, of course, the fact that interest rates are very elevated relative to where we have been, is there some form of a unilateral debt swap coming? Now, this is something that I think, whilst it sounds kind of far-fetched, I would definitely not rule it out. Why? Because Trump can very much tie this into the negotiations going on with partners, okay, with his trade partners. And it sounds something like this. Hey, Europe, look, how about we go easy on you with the tariffs, but in exchange, that maturing debt that, that we need to refinance, we keep it at the same terms as previous, we just extend it for another 10 or 20 years. Okay, and that way they can use it as a negotiation tactic. So I would definitely not rule this out, but there are going to be implications if this ever does become a thing. Okay, now the key thing, if you go and read through this, you can take a picture of that, definitely read through it. This was used, of course, by Greece. It was used very effectively by Greece, and we know fine well that Greece is one of the very few outperforming economies at this point in time. They were effectively bankrupt during 2014, and now they're one of the best performing economies in Europe, okay, because they did this thing called a debt swap, okay. Now, there is a way around this. This legally is very easy to do. And again, you can go and read about why it's relatively easy to do. All you need is effectively Congress to agree to make the change. And your debt holders have to kind of accept whatever you put in front of them. Okay? Now, the key takeaway I want to stress from this is, should this happen, should effectively debt holders be forced to roll their debt in essence, there will, of course, be court case challenges. There will, of course, be a number of legal issues that need to be overcome. But the reality of the situation is that investors, as well as, of course, markets' general thinking about the safe haven status of the US, will definitely be called into question. Okay. Moreover, we will see a lot of the ratings agencies turn around and say, hang on a sec, this stuff is no longer the most safe haven asset around the world. There's far better alternatives like, of course, what we're seeing going on in Germany and Europe in general. Okay, so the point is, were we ever to see something like this, were we ever to see Trump come out with a comment saying, hey, how about we consider this whole idea of a debt swap? The reality is the market is going to sell those long-end bonds quite aggressively, and we will see a little bit of panic around this because it is something that it's not normal. Okay, it is very much something that will scare investors. Now, why am I bringing this up? Okay, well, the reality is that the US this year has to refinance about $9 trillion of its debt. Okay, and that's roughly around 33% of its outstanding debt. Okay, so 1 in 3 of its debt is maturing this year. Now, most of that is short-dated, and most of it is likely to be extended short-dated. Why? Because right now, the US government is sitting with 30-year yields at around 4.5%. Okay, now why does that matter? Well, if you go look back at the years, call it 2018 to 2020. Okay, imagine you're the US government, and you're rolling your debt or effectively issuing debt. You're issuing it somewhere around, call it 2.4%. Okay, so imagine you're issuing 2.4% 30-year debt, and now all of a sudden, fast forward, you've got debt maturing and you need to roll over that debt, and now you need to go and effectively issue that same debt around 4.5%. Okay, that 2% difference is significant when you've got 29 trillion of debt in total. Okay, moreover, when you've got to roll over 9.2 trillion of debt in one single year, that is a significant amount of debt to be issuing at much, much higher yields. Now, of course, most of the US government's debt is done on the front end, is done very short dated for obvious reasons. They don't want to lock themselves into 4.5% 30-year debt. Okay, but a lot of the 10-year debt, a lot of the 30-year debt does have to also be rolled this year. And those maturities, of course, are going to be issued at much, much higher yield. Okay, and that's why this idea of a debt swap is something to keep very close eye on, because like I said, Donald Trump's objective is he wants this yield down so he can issue at lower yields so the US government can escape this little bit of a debt trap that it's currently falling into. The reality is they're not getting those yields down, and so they may be forced to become creative with how they issue debt this year. Okay. The alternative, of course, is, like I said, they just issue more of the debt via shorter time frames, so they effectively lock in for only 1 year instead of 10-year or 20-year. But the point is debt auctions are going to become massively important to watch over the course of this year, and of course any rhetoric around how they're going to issue. Now, interestingly, of course, don't forget, I think about 65% or 70% of the debt is going to be issued already in the first 6 months. Okay, so a lot of this debt load of 9.2 trillion is going to be rolling over already in the next 6 months. So in particular, bond yields are going to struggle to come down meaningfully with all this issuance. Okay, that's the key takeaway. If you're looking at these bonds going, I think it's a good time to buy yield because ultimately, the US economy is slowing. Fine, I get that logic, but perhaps you need to wait for all this issuance to be digested by the market, and then in the latter half of this year, you might actually start to see yields back off a little bit. Okay, keep that in mind. Now, with that in mind, of course, our final discussion topic for today is all about Bitcoin, and it's not a safe haven asset. Do not think it's a safe haven asset. Do not go on Twitter reading about how all of a sudden, because it's bouncing aggressively, it's proving itself as a safe haven asset. That's bullshit. It's not a safe haven asset. If it was a safe haven asset, it would be performing a little bit like gold, which currently year to date's up 30%. Okay. Bitcoin is not a safe haven asset. It's proven itself to not be a safe haven asset because when the Nasdaq in red was selling off starting in February, what did Bitcoin do? It sold off starting in February. Okay, it's mapping effectively almost identical what the Nasdaq is doing. Okay, now my point of this chart is not to come out and say it's not a safe haven asset. Okay, my point of this chart is to tell you what it is, which is when we see a little bit more stability coming back into the Nasdaq. So when we get that bounce in the Nasdaq, look how much easier Bitcoin bounces. Okay, and that's the key thing I want to stress here, is that Bitcoin bounced at the exact same date as Nasdaq did. Okay, they both bounced identically. We can see, however, that Nasdaq then went off at a second time, whereas Bitcoin went sideways. Okay, in other words, when we finally do see a little bit more risk on environment come back to the markets, Bitcoin's going to tend to outperform. Why? Because there's no one sitting on the offer needing to get out of big trades. Okay, I think that's the key takeaway. The bounces will be more aggressive than the Nasdaq, but the trend will be identical. Nasdaq goes down, Bitcoin's going down. That is all you need to know. And if you think otherwise, you need to go and explore Bitcoin's relationship with Nasdaq over the course of its inception from 2014. Okay, that's the key takeaway I want to stress here. Yes, I think Bitcoin is now coming into a very interesting area. We are going to be testing a sort of a VPOC somewhere around 97,000. I think that's a key area for Bitcoin to keep a close eye on, where it can perhaps just back off a little bit. Also, I think pay very close attention to what we do around this 96,000. You can see we got sold very aggressively there recently. So don't be surprised if we get up there today, tomorrow, to see it get sold back down towards that 91,000. Okay, like I said, if Nasdaq bounces and Nasdaq holds a risk on sentiment, that's a good environment to buy Bitcoin because you're going to have a much easier time to the upside. But once Nasdaq rolls over and perhaps starts to sell off again at some point later on this year, don't be surprised to see Bitcoin moving its way back down towards that 74,000. All right, that is then a wrap for today. If there are any other questions, do post them in the Discord channel. Otherwise, as always, good luck out there. Manage that risk. Go make some money.